Hello everyone, I'm Deep Purohit, and today we are going to discuss a critical topic from our Indian economy and policy course, India's current monetary policy in 2025 and how the Reserve Bank of India is steering the economy amid both domestic and global uncertainties. Over the past few decades, India's monetary framework has evolved from a highly regulated system to one that embraces gradual liberalization. In today in 2025, our central bank is once again at the forefront of policy innovation as it employs measures such as rate cuts and liquidity injection to support growth. Recent news indicates that RBI is expected to implement additional rate cuts at upcoming meetings to counter subdued growth and low inflation levels. This video will explore these measures, analyze their implications, and discuss what they mean for the future of India's economy. So let's begin with a brief historical context. Post independence, India adopted a model of heavy state intervention. However, landmark liberalization reforms of 1991 set India on a path toward market oriented policies. Over time, the RBI has transitioned from an era of high control to one that is more responsive and adaptive to both domestic economic signals and global trends. Today's monetary policy tools, such as repo rate, liquidity injection, and open market operations, are not only technical instruments but also reflections of our evolving economic narrative. This context is essential to appreciate how far we have come and to understand the technical choices made by the RBI today. So now turning to the current context, in recent months, the RBI has been tightening its stance on interest rate adjustments. With inflation hovering over near its lower bound, recent figure indicates levels between 3.6% to 4.2%, which is taken from Reuter's report. The central bank has found room to ease monetary conditions. In the upcoming policy meeting, economists largely expect a 25 basis point rate cut, which is intended to lower the cost of borrowing, stimulate bank lending, and eventually boost consumer spending and private investments. So let's break down how this tool work. The repo rate, which is the rate at which commercial banks borrow funds from the RBI, plays a pivotal role. When the RBI cuts the repo rate, borrowing becomes cheaper for banks. In turns, these lower costs are passed on to consumers and businesses, facilitating investment in infrastructure and industrial activities. This transmission mechanism is vital for enhancing aggregate demand in the economy. At the same time, the RBI has been actively injecting liquidity into the banking system by increasing the money supply. Uh, the central bank is aiming to counteract any liquidity deficits that might dampen credit growth. These liquidity measures are especially important given the backdrop of global headwinds, rising US interest rates, trade uncertainties, and geopolitical tensions that can disrupt capital inflows. Furthermore, it's crucial to recognize the interplay between domestic policy and global factors. For instance, recent actions by the US Federal Reserve and tariff signals from the US administration have indirectly influenced India's monetary policy decisions. A stronger US dollar tends to attract foreign portfolio flows away from emerging markets, including India, thereby exerting pressures on the rupee and necessitating proactive measures by the RBI. So, but what does all this mean for the economy? Technically speaking, lower borrowing costs should encourage investments in capital intensive sectors, thereby boosting production and employment. However, there are also risks. Over-easing, if not carefully calibrated, lead to excessive borrowing or asset price inflation. It's a fine balance. The RBI must support growth without igniting financial instability. So let's summarize the points. Historical evolution: India's monetary policy has transitioned from a highly regulated approach to a more flexible market driven system. Current measures: the RBI is employing rate cuts and liquidity injection to counteract low inflation and stimulate growth, especially in light of global economic headwinds. mechanisms and impact. Lower repo rates reduce borrowing costs, encouraging investments and boosting consumptions, but they require careful monitoring to avoid financial instability. Future prospects: while these policies can provide short term relief, long term growth will hinge on structural reforms in key sectors. So, in conclusion, India's monetary policy in 2025 reflect a nuanced technical response to both domestic and global challenges. Thank you for watching.